Have you ever found yourself buying stocks halfway up the mountain, only to watch the price continue to plummet? Fear not, for I have great news. By optimizing the CCI parameters, you can easily capture the bottom.
Nice.
In this video, I will demonstrate how to identify the ideal entry point in the midst of a market crash. Join me and discover the best trading practices, and don't forget to like, subscribe, and stay tuned for more informative videos on trading strategies. Today, we will focus on the CCI bottom fishing model used by institutional investors. But before we dive into this approach, let's first understand the composition of the CCI indicator. It consists of 3 horizontal lines and 1 curved line. The resulting CCI value oscillates between plus 100 and minus 100. A value above plus 100 indicates that the asset is overbought. Its price has risen too much too quickly, while value below minus 100 indicates that the asset is oversold. Its price has fallen too much too quickly. In this model, we will utilize the red and blue lines. For practical applications, there are 2 key points to note. First, when the CCI indicator shows an abnormality, meaning the red line crosses below the blue line for just 1 day, and then crosses back above it the next day, a prime opportunity arises for institutional investors to initiate positions at the extreme bottom. Second, as the price starts to pick up and the institutional investors begin to accumulate shares, that marks the lowest point to enter the market. Don't miss out on this golden opportunity. Alright, let's take a look at an example of how the CCI bottom fishing model works. As you can see in the chart, after a period of rapid decline, the CCI indicator shows a red line crossing below the blue line, indicating that the stock has entered the buying zone. The next day, the red line crosses above the blue line, indicating that the stock has hit rocket bottom. At the same time, there is a price surge as evidenced by the bullish engulfing pattern on the candlestick chart. The stock then takes off, soaring 86 in just 11 days. By mastering the CCI bottom fishing model, you too can easily buy in at the lowest point. Let's take a look at another stock in the chart. After a period of downward trend, the red line of the CCI indicator crossed below the blue line, followed by the red line, crossing above the blue line on the next day. At the same time, the price displayed a bullish engulfing pattern, indicating a potential price surge. Additionally, there is a clear double bottom pattern with a long lower shadow, which is a resonance buy signal. As expected, the stock price quickly surged upward in the short term. Learning the CCI bottom fishing model can help you identify these opportunities and maximize your gains. To summarize the CCI bottom fishing strategy, there are 2 main points to remember. First, the CCI indicator must show a signal where the red line crosses below the blue line, followed by a cross back above the blue line within 1 day. This creates a high probability bottoming pattern that is often exploited by the big players in the market. Once a price breakout occurs, it's a clear signal that the market makers are in control, and it's a good time to buy in at the lowest point. Secondly, the price breakout must be confirmed with a bullish reversal candlestick pattern, such as a bullish engulfing pattern. By combining these 2 criteria, you can create a reliable CCI bottom fishing model that can help you quickly profit from short-term price movements. Finally, if you want to master the CCI bottom fishing strategy and learn more profits from the stock market, don't Don't forget to comment HHH to get the optimized CCI parameters. Also, feel free to share your own trading experience and questions in the comments. Remember to subscribe, share, and like to spread this practical knowledge to more investors. Stay tuned for more exciting content in the next episode.